As an overall demographic, the baby boomer generation has accumulated substantial wealth as a result of economic growth, financialization, and hard graft. Much of this wealth is in illiquid forms that governments and financial institutions have shown great interest in accessing. At the same time, rising inflation, increasing living costs, volatile markets, and policy pressures on pension funds have created conditions in which traditional retirement savings may be insufficient for many retirees. Banks and governments worldwide are exploring ways to access retirement wealth. This places additional pressure on older citizens to reconsider how they manage their assets. Conveniently, asset tokenization is emerging as a potential solution that promises liquidity, diversification, and potentially protection in times of need. Meanwhile, the recent executive order expanding 401k access to alternative assets encourages baby boomers in the US to take on greater investment risk. It plans to allow private equity, real estate, commodities, and digital assets into the mix. This will likely increase volatility. This means retirees that are near or in retirement face increased uncertainty. There's the possibility of higher returns, yes, but this goes alongside increased exposure to losses. There's also liquidity constraints of private equity and real estate, and complex regulations to consider. Those who lack expertise or advisory support may experience increased portfolio risk at a stage when maintaining income stability is most important. Here in the People's Republic of the UK, speculation is intensifying regarding potential changes to pension tax rules. Reports suggest that the Chancellor is considering reducing the tax-free pension lump sum, which currently allows individuals to withdraw up to 25% of their pension pot tax-free, which is capped at £268,000. They argue that this change could raise over £2 billion annually for the apex predators of the financial world. Unsurprisingly, the IMF has endorsed such an approach by stressing that the government may need to make difficult decisions to rebuild fiscal buffers due to the aging population. Such issues and attacks are affecting the entirety of the Western world. As the so-called cost of living crisis has been embedded throughout the West, many, including retirees, face financial instability. Negative real rates, where nominal interest rates are lower than prevailing inflation, undermine savings, while healthcare, housing, and energy costs all continue to rise. In Canada and Australia, governments are adjusting tax-advantaged retirement accounts to meet fiscal needs. European nations such as Germany, France, and Italy are scaling back defined benefit pensions or increasing social security contributions. These developments show that the challenges facing baby boomers really are international, highlighting the need for strategies that preserve financial security. A significant portion of baby boomer wealth is tied up in illiquid assets such as primary residences, holiday homes, private businesses, and collectibles. These assets cannot be easily converted into cash, yet they represent the bulk of accumulated wealth for many retirees. Concentrated illiquid holdings create tension. Retirees need liquidity to cover rising living costs and emergencies, but selling these assets outright can diminish lifetime wealth and inheritance for future generations. Traditional retirement portfolios consisting of equities, government bonds, and cash are clearly vulnerable in this overall economic environment. These measures illustrate that retirement wealth is increasingly influenced by government policy, which is prompting baby boomers to explore alternative strategies. There is further discussion here of capital gains tax rises, and now we see regular commentary and discussion of inheritance tax at 100%, which in reality is simply state-sanctioned wealth confiscation. Just listen to this.
Also true of the United States as well. So what I would do what I would do, and I wouldn't be opposed to, by the way, I wouldn't be opposed to 100% inheritance tax. Or maybe let's say 99%. You know, my rule might be that if you can put it in 2p bags, then you can hand it over. That's fine. 99, 95%. I'm being provocative, but you see what I mean. I would not be against a far higher rate of inheritance tax than we have at the moment, which is 40% above a certain threshold. I wouldn't be opposed to putting that to 50%, 60%, 70%. Why? Because I think the quid pro quo should be twofold. One, that helps fund public services, which actually helps level the playing field in achieving a true meritocracy. Two, it will help us reduce taxes on income. Because at the end of the day, I want to incentivize work. I want to incentivize productivity. I want to incentivize people to get up off their backsides and do more. You don't have a right to inherit. You should have a right to work while you're alive and keep more of your own money. That to me is more important, way more important than your right to just inherit some money from mummy and daddy that you did nothing to earn.
Amidst economic strain, illiquid wealth poses a key vulnerability for retirees. There must be in the corridors of power a consideration that in emergency, many will require access to funds quickly in the face of any sort of crisis or policy-induced issue. Enter stage right tokenization. This will clearly build a capability which would allow retirees and others with considerable illiquid equity to create digital tokens representing fractional ownership of their own real-world assets, splitting real-world assets into digital shares if you prefer. Additionally, tokenization can be touted as an investment option to generate yield. These tokens can be traded or sold on digital platforms, providing liquidity and diversification, potentially. In addition, this could enable access to equity by converting illiquid holdings into cash without selling the asset. For example, a 400k property could be tokenized to generate 100,000 to release equity, while also enabling the asset owner to maintain overall control. And of course, they would, however, be subject to the terms of the smart contract. There's also diversification of investments, access to commercial real estate, farmland, commodities, and private equity in global markets, which could theoretically reduce reliance on domestic equities and bonds. In theory, such an approach could also help to manage inflation as a potential hedge. Tokenized property and commodities could help maintain value during rising costs. There's also the crisis response, as we've alluded to, where boomers could seek to liquidate fractions of holdings, cover essential expenses, and reduce exposure to sudden income shortfalls. While tokenization may have its advantages, it also carries risks. Regulatory uncertainty, cybersecurity threats, and especially low market liquidity. Tokenized assets may look flexible, but without enough buyers, they can be difficult to sell quickly or at a fair value, leaving those with tokenized access unable to access the cash when it's most needed, and it really exposed to financial strain. So what options are there to preserve key assets? Well, those who prefer to avoid tokenizing core assets in an effort to maintain generational wealth are typically offered this classic menu of largely unappealing options. This includes delayed retirement, equity release and reverse mortgages, opting for income generating assets such as dividends, bonds or property while being exposed to market risk, tightening their purse strings, or even structuring trusts to allow liquidity and to protect assets for future generations. However, increasingly, retirees are turning their backs on the chains of over-indebted Western economies by embracing unconventional adaptations. Some are opting for RV or van living. Others take up permanent residence on cruise ships, while many repurpose spare rooms through Airbnb-style projects. A growing number are relocating abroad to countries with lower living costs and more relaxed lifestyles. It is deeply wrong, of course, that people should face such hardship after decades of work. Yet preparation and clarity in the face of economic reality, I believe, are essential. In the UK, government hostility towards private landlords has already pushed many, including my own mother, to abandon long-term rentals in favour of Airbnb. This policy shift has not only distorted retirement planning, but also contributed directly to the worsening rental crisis that we're currently suffering. It's likely that the earliest adopters of tokenization beyond money market funds will not be average retirees, but most likely those with large illiquid assets who are cornered into finding liquidity without selling outright. Boomers are being boxed in by inflation, policy rates, and financial engineering that steadily erodes the safety of traditional retirement options. Tokenization will soon be marketed as a saviour, promising liquidity, diversification, and protection. Yet it also exposes retirees to opaque markets, technical risks, and deliberate complexity. The pattern is clear. Governments and financial institutions want greater access to illiquid private wealth, and they are shaping the rules to make that possible. In this environment, physical gold and silver, of course, stand out as key assets outside the system's reach. Some may like cryptocurrencies, and if that is your preference, fantastic. For everyone else, being able to actually thrive amidst such threats will depend on vigilance, cutting unnecessary costs, generating independent income, and resisting pressure to hand over key assets into digital cages disguised as innovation. Only by combining resilience with skepticism can baby boomers preserve independence and protect what they have built over generations against a system that is sadly not designed for the security of any of its citizens. Now, thanks so much for joining me. Do check out this other video here, and I look forward to seeing you next time. Thanks ever so much. Bye-bye.